Hey, fellow investors, have you ever wondered how you can keep more of your hard-earned money instead of handing it over to the taxman? Well, you're in luck, because today we're diving into 7 smart tax strategies that can help you do just that. These aren't just for the wealthy elite. They're practical tips that can benefit investors at all income levels. So let's get started. First off, let's talk about maxing out your contributions to tax-advantaged accounts. This is probably one of the easiest ways to reduce your taxable income. I'm talking about your 401k, IRA, and HSA. For example, in 2024, you can contribute up to $23,000 to your 401k if you're under 50, and even more if you're older. That's a significant chunk of change that you can shield from taxes. Plus, your money grows tax-free in these accounts. It's like giving your future self a big financial hug. Now, let's move on to a strategy that might sound a bit counterintuitive: tax loss harvesting. This is where you sell investments that have dropped in value to offset gains in other areas. I know, it sounds weird to sell something at a loss, right? But hear me out. Let's say you bought some stocks for $10,000, and now they're only worth $8,000. If you sell them, you can use that $2,000 loss to offset gains in other investments, or even deduct up to $3,000 from your ordinary income. It's like turning lemons into lemonade. For those of you working from home, listen up. You might be able to claim deductions for your home office expenses. This includes a portion of your rent, utilities, and even your internet bill. Just make sure your home office is used exclusively for work. I've set up a dedicated space in my spare room, and it's been a game changer come tax time. Now let's talk education. If you're hitting the books, you might be eligible for the Lifetime Learning Credit. This can give you a credit of up to $2,000 per tax return. That's money directly off your tax bill, not just a deduction. I used this when I was taking some online courses to upgrade my skills, and it made a real difference. Speaking of education, have you heard about 529 plans? These are amazing for tax-free education savings. You contribute after-tax dollars, but the earnings grow tax-free, and withdrawals are tax-free when used for qualified education expenses. I started one for my niece when she was born, and it's growing nicely for her future college costs. Here's a strategy that requires a bit more planning: deferring income or accelerating deductions. This is all about timing. If you think you'll be in a lower tax bracket next year, try to defer some income to then. Or, if you're in a higher bracket this year, see if you can accelerate some deductions. For example, I once made an extra mortgage payment in December to get the interest deduction in that tax year. Lastly, and this might seem obvious, but keep organized records. You'd be surprised how many deductions people miss simply because they can't find the receipts. I use a combination of apps and a good old-fashioned filing system to keep track of everything. Trust me, it's worth the effort when tax time rolls around. Remember, these strategies aren't one-size-fits-all. Your specific situation might call for different approaches. That's why it's always a good idea to consult with a tax professional. They can help you navigate the complexities of the tax code and make sure you're making the most of these strategies. I hope these tips help you keep more of your hard-earned cash in your pocket. Remember, it's not about how much you make, but how much you keep that really counts. If you found this information helpful, please give this video a thumbs up, share it with your friends, and don't forget to hit that subscribe button and notification bell so you never miss out on more money-saving tips. Until next time, happy investing. Please like, share, and comment to help this channel grow.